Good afternoon, ladies and gentlemen, and welcome to another edition of the weekly Precious Metals and Commodities weekly update, where we go through the precious metals and commodities that are available on the OANDA FX Trade platform and take a look at where we think the markets could be going, where they've been, and some of the factors that will be affecting them over the coming week. It will be a packed week this week with a very data-heavy end to the week. Highlights being, of course, the Bank of England on Thursday and culminating with the US non-farm payrolls on Friday. We saw some excellent GDP data out on Friday evening, which was some of the best for some time from the United States, and that saw the US dollar go for another rally again. This saw various things such as gold come under pressure. It will be interesting to see whether that data has continued into the end of the week, and we are expecting a huge non-farm payrolls bounce back from the hurricane-affected number of last week, talking of something around the 300,000 plus. The US dollar has been on the ascendant, and US yields have continued to rise. Somewhere along the way this week as well, we will also get the announcement of the new Federal Reserve Governor. I am told that the latest update there will be for Thursday's announcement by Donald Trump. So we wait that with eagerness as well. Right, well, let's just crack straight into it and go straight to the first chart in front of you, which of course is gold, where we normally start. And we can see gold's actually staged a bit of a rally this week, which is rather interesting. But I think what we need to understand here as we look at this down channel that gold has been in for the past couple of weeks is that the bounce back has been very modest, led mostly overnight by a generally weaker US dollar, which saw some profit taking, and US yields moving slightly lower. We have managed to regain the 100-day moving average, if I just blow this chart up, this red line here. But really, we're just sort of pivoting on it, and we still really haven't made much progress out of this down channel. This red line, the 100-day, is at 1275.75 today. All in all, it does look like a dead cat bounce, and gold's fate really is tied to the fate of US yields and the US dollar. There seems to be no risk premium, safe haven premium built into gold at all at the moment. So it definitely does look like it could still be a sell rally scenario. Behind here we have, above here we have some congestion around 1283.75, a series of 3 daily tops. Above this we have 1291.60. Around the 1296 area. So there's quite a lot of wood to chop on the top side. The real key though is this level here, this thick red line at the bottom, and we can see this is around the 1260 region, and it also intersects with this blue line, which is the 200-day moving average, which is at 1260.30 today. There's still extreme long positioning from the Commitment of Traders report that is admittedly backward looking by a week. That came out on Monday and showed that there was still very, very strong speculative long positioning in gold, although it is pretty much flattened out on most of the other precious metals. I think there's a good chance that this 1260 area will be the level that is the key to the continuing longevity of those long gold positions, and that if we see a daily close below this 1260 region, that will be a big signal to the market to raise the white flag and head very promptly to the exit door. So over this week, do keep an eye on this 1260 area. It does look on the charts that it is actually a key area for support for gold, and it could actually be the pain threshold for a lot of longer term bullish positioning. Let's head over to silver. Silver itself, if I just squeeze this chart up again, it really hasn't come back to the same extent as gold. I think a lot of this has to do with the fact that people just haven't been as strongly positioned either long or short in silver. It does still have a long position in the COT report, the Commitment of Traders report, but really it's not nearly as large as the gold one, which was something like around 250,000 contracts. So still sizable positioning. We can see that it is flirting with the 100-day moving average, this red line here. And I think I said last week to you that the 100-day appears to be a bit of an intraday pivot at the moment. So if it falls through, it tends to extend, and when it moves back up, it tends to extend. And it in between, it has actually held that last week and a bit quite well, held all those bounces, sell-offs, quite successfully. We did fall through it on Friday night after those GDP numbers. And since then, it has actually struggled on a closing basis, if we look at these little horizontal bars, to regain that 100-day moving average, which today is at around 16.8625. Very quiet day here in Asia today, but really we are going to need to see, I think, from a technical perspective, a close above this 100-day moving average before traders can start breathing a bit of a sigh of relief if they actually have long positioning on. Behind there, we still do have this double top here on the dailies, which comes in quite closely behind at 17.0475. Then, of course, we have the 200-day moving average, this blue line here at 17.19. Down below, we have a series of lows, daily lows at around the 16.54 region. And then this is the key region here, just below here, the 16.3270, let's call it, this spike lower that occurred in early October. I think, again, a bit like gold, if we were to see this level break, we may actually see a few traders heading for the exit door, and maybe even some new shorts being put on. It doesn't have quite the same, excuse me, extreme positioning as gold, so maybe the movement won't be as much. I am looking at this peak in the middle of the chart, this left-hand side and this right-hand side for a possible head and shoulders formation, which would imply silver's going a lot lower. But I think it's a bit premature for that, and I actually do think it's a bit of a marginal formation as well. But I'll come back to you with some more updates on that next week. Platinum, the precious metal nobody loves to love. Again, it's failed, as we saw last week, at this 100-day moving average. That's the real standout here. So this level here today is around 944 for platinum, closely followed by this 946 region. Excuse me about that. Which I think will be quite a formidable resistance now on platinum. This was a pretty negative. In fact, it was an outside reversal day, to be honest. We made a new high and then finished with a new low on that day when it failed at that average. So I think this is a very key region now if platinum wishes to recover. Speculative positioning is very, very light in platinum at the moment. So I don't think we can get any joy out of that. And this key level here, 903.85 with 904 region, and the 890 area, if we blow this chart up, the 890 area is clearly, as you can see now, when you look at it from a bit of a longer term perspective, a key support area. If we see 890 break and close on a daily basis, assuming that the RSI doesn't go severely oversold, then that would actually imply from a technical perspective that platinum is looking at substantially lower levels. Of course, this is all predecessed on a stronger dollar. What's happened there? Let's try that one again, hey? The same can't be said for palladium, which is the metal that just the world just keeps on loving. Again, this 947 area has still not been tested, even though silver, gold, and platinum have both have all come under pressure. Palladium seems to be much more closely aligned to some of the industrial metals at the moment, although they haven't had a great week, as we'll see. But when we look at it in the context of the longer term uptrend, the longer term uptrend level comes in at around this 861 region. We have the 100-day moving average at 910. This longer term support at 947, and even we could talk about the 200-day moving average way down here at 849. there is a lot of support technically for palladium on any dips, and that's certainly been how it's been performing. Once it broke this resistance, it spiked higher, and it does seem to be consolidating above that. In order to get bearish on palladium, we would have to see this metal drop well over $120 from present levels in order to start turning the tide there. So I think it's steady as she goes. One thing I do note is that on the two spikes above 1,000 we've had recently, we have had some quite quick corrections. So I think for some renewed vigor in this rally, we may have to see a couple of daily closes, consecutive closes over the $1,000 an ounce area before we can actually say to ourselves that maybe the rally is starting in earnest again. So I guess daily closes above 1,000 and then at least $120 drop below this long-term support line are required in order to give some new direction to palladium. We pop over to copper, which hasn't had a great week. Industrial metals in general haven't had a great week. I think if you look at it in the context of the bigger picture here, this chart that goes back to well over a year ago now, we can still see that we're in a fairly solid uptrend. But the key here has been this week has been coal, which has been under severe pressure. Iron ore has been under severe pressure, and the reason they've been under pressure is because of the huge increase in stocks that are sitting in Chinese ports, and that has actually had a drag effect on other base industrial metals like zinc, copper, etc., etc. So where China goes the industrial metals market. So we've seen this big drop here when that data came out on Friday, and then it's been a bit of a dead cat bounce since then. If we were to blow this chart up, we can see that support would be around this daily low from Friday, which is the 305.85 area. That would be our first line of support. Oh, let me just draw a quick line around here. After that, we moved down to this congestion level where all these daily highs occurred, the 297. This one here is now a bit marginal. I'm looking at this low and this low. I think the more valid one would be 284.72. Although I do note that the 100-day moving average is coming in around this line here at around 289.60. But there is a fair bit of wood to chop still, even though we have had a bit of a pullback in copper. And I have a feeling that, assuming that the Chinese Kaizen PMIs come out okay tomorrow, then maybe copper may find a little bit of lease of life. We need to actually blow this chart up quite substantially in order to see this 3.30 resistance line, which shows you how far back it goes. It goes back an awfully long way. Way back into the 2000 and well, even further back than that, way back into the 2014s. So if we see a daily close above 3.3, probably a couple of consecutive ones, this would imply that this long-term top dating way back to mid-2014 is broken, and that we could be heading up towards the 3.5 level. So definitely this is your pivot level at the moment, 3.30. Let's head over to the energies now. Natural gas. Again, with the moves in Brent crude over the last few days, which we'll talk about in a moment, natural gas just seems to be the forgotten energy. I think this is the way it's going to continue for the foreseeable future. Really not a lot to say here. I said the other day that it was ranging still between this 3.107 and this 2.75. We do seem to be consolidating more and more and more under the 100 and the 200-day moving average. So a break now, because we've been in this range for so long through this 275.40. We can see the previous lows here and here. So we've got 1, 2, 3 lows at this level. Would imply that we will be having a test to the downside. The next target would be, let me just draw this line for you, this previous spike at around in early mid-February, and that comes in around sort of the 254 level. So keep an eye on this 275. It's hard to get excited about natural gas until we either see a break of 275 or this 3.11 region. Let's go to something a bit more exciting, which of course is Brent crude, which has finally reached sort of OPEC, non-OPEC's nirvana of $60 a barrel. It touched 61 overnight. Extremely positive price action here as the Saudis came out and said they were fully supportive of a deal extension, a production cut extension through to the rest of next year, which is following on from what the Russians have been saying. So that's the world's two largest producers coming out and saying that. In the OPEC and Non-OPEC grouping. The Saudi Crown Prince over the weekend also came out and reiterated the same thing, that he was determined to see supplies in storage run down, and that he wanted to see the production cut deal extended for the whole of 2018, and that gave oil a big boost, falling into the weekend and into Monday. Surprisingly, we got through 60 quite easily. I was expecting there to be a bit more action there. We did nibble at 61 overnight, and perhaps if I move this line up a little bit now, it's probably more valid to do this. That is your initial resistance, 61, which was the overnight highs. We have some support around 60, which will be sort of psychological. And then we come down to around the 59 area. And then following that is this uptrend line, which I've drawn on, which has got three lovely points and are almost over here. And that comes in at around the 57.85. So actually, it's quite easy at the moment with Brent. 60, 59, 58. And then, of course, we come down to the longer term support line here, which is around the sort of 56 level. So you can see just how strong this rally's been. Brent crude will have to fall an awfully long way and break this support line around the 56 region in order to make the rally in danger. The prompt futures are still in backwardation, which is a structurally bullish setup on the futures market, and inventories are running down. If we have a look at the bigger chart, it is actually quite a lot of clear air up here, to be honest. I'm going to have to squash this up and make it look a bit painful. But we can see here the next real serious area of congestion is the spike here at the early 2015 around the 69 region. We have some congestion here from 2015 as well, which comes in at that 61 region. So I think that actually makes this all the more interesting as the next resistance. But once we're through there, there is an awful lot of clear air up here, and I can't see any particular technical resistance in those areas. One caveat I have for you all viewing this is I note here this blue circle I've drawn, ellipse on the RSI. We can see that the RSI is just heading up into strongly overbought territory. Now, the RSI over the last 12 months has been an excellent indicator of short-term highs and lows when the market's got ahead of itself. So although the setup does look bullish, I think because it's had such strong price action, it is perhaps a little vulnerable to a potential pullback, should there be any bad news. Let's just crack on and get into West Texas Intermediate. Much the same again. We are now testing this grey triangle, which is this long-term resistance region between 53.5, 54.5. We're sort of deep into it now at around the highs of sort of 54.25. Again, the near-term support line comes in at sort of 52.37, 52.40, which coincides with this 52.5 line that I've drawn already on the chart. We really need to fall below this 52.5 in order to sort of start getting nervous about WTI's rally. Even in the face of less than impressive inventory data last week and record US exports, we still seem to be pushing higher, and does seem to be a definite lack of producer hedging going on in the futures at the moment. if we break through the top of this rectangle here, 54.5, 54.70 area, this would imply that we are heading to much higher levels. Let's go over to sugar now. And the word of the day is ethanol. Now, you're probably asking why I'm saying ethanol when we're looking at a sugar chart. Well, actually, the rise in crude has actually pulled the price of ethanol higher, and thus the components of that are used to make ethanol, some of the more popular ones being sugar and corn, have also been pulled higher. So as the price of ethanol goes higher, thus producers of the crops that are used to make it, it's plant-based, they tend to move higher as well. And this is what we've seen over the last couple of sessions. I'll just blow this up a little bit for you. If we have a look here, we can see actually a very good move all the way from 13.5 up to the 14 sort of 20 level. And then we've continued that bounce. Again, this 100-day moving average has been a pivot. You can see that for the last couple of months, it's pretty much held any sort of incipient rally in sugar. Once we actually blew through it, we really did blow through it. So I think actually sugar's rally is probably dependent on how the rally is sustained in oil, which again will hold up the price in ethanol, which again will cause demand for sugar and thus support the price. Having said that, we are definitely still in the range after a very, very, very long-term sell-off. And before I start getting really excited about sugar moving structurally, we do need to see this 15 or level break. And if we see this 12.5 level break on the downside, that probably means that life is not working out as expected. So in the bigger picture, 12.5, 15.5, we are still ranging. In the short term, we are looking constructively bullish according to the charts. Let's go to soybeans. And again, this has been a rather disappointing effort on the soybeans part. We saw this this breakout of this triangle. It is coming very, very close now to being invalidated. I think I'll chuck the towel in on this one on a break of the 100-day moving average, which is sitting around the 960-70 region. I think that would be the level where we can throw in the towel on this breakout and we can take these lines off the chart. In the meantime, we do seem to be testing the 200-day moving average at 971. And I think if we close below that, we do have a pretty high chance of retesting this 100-day moving average. Up above, we have resistance at 980 now, and then of course at the 10 level. The price action has not been constructive at all. You know, we've had one huge spike and then a slow death over the last couple of weeks. Sometimes these things work out, sometimes they don't, and that's life really. But there's no particular drivers to the soybeans. I just think with the other soft commodities all being pretty much heavily sold on any rally, then it's been quite hard for soybeans to sustain that as well. Let's move to corn. Again, another very popular crop used in the making of ethanol, and we've seen a spike to the top of the range, but we've held this 348 level and drifted off again, and we really haven't seen much of a corn following the price action of sugar. I guess what the move up on the price of ethanol has done is actually perhaps put the moment of reckoning off for corn itself. There's been fairly mixed data over the last over the last week or so about the potential crop and about exports, etc., etc. I think as long as we stay below 348 and above 329.5, it is a little hard to get excited about corn, and the structural downtrend that it's been in for quite some time is still going to be continuing. Behind that, of course, we do have the 100 and the 200-day moving averages, which I think will also be very, very difficult to break. In fact, it's very hard to get excited about corn just for now until we see this 358.5 go. But in the meantime, 348, 329.5. Do keep an eye on it though. if Brent, Crude and WTI continue to move strongly higher, as that may actually give some unexpected support. Let's have a quick look now, just to wind it all up, at wheat. Again, lots of talk this week about cropping levels, particularly in Argentina, and also the potential crop for next year. The talk is that in the United States, that the amount of wheat that will be planted in 2018 will be substantially higher than for 2017, and that has weighed on prices. And if we can just draw a little line through here, we can sort of marginally see 1, 2, 3, 4, 5 points at around the sort of $4.09, a bushel, I guess it is, level. So we have gradually moved back down to it. We have failed to even remotely test the 200-day moving average, this blue line, and we certainly haven't got anywhere near this joint red resistance line at 439 and the 100-day moving average at 440.5. So all in all, the price action hasn't looked particularly special, to be honest, in this particular case. And we will need to see, I feel, a break above this 200-day in order to get excited again. I think the danger looking at this is that we break through this 409 level and then go down and test this 393.70 long-term support region. So price action not looking too special in wheat at the moment. Well, that's it for this week's roundup. I hope you found it interesting. Do send some comments in if there's something I can do to make this a bit more engaging for you. And otherwise, it's going to be a very, very busy week. So manage your risk correctly. And I wish you all the best and profitable trading for the rest of the week. And we'll talk again next week. Thank you for listening in.